Hey everyone, welcome back to Talking Success. We've got a great episode for you this week with Nelson Chu, who's going to talk about an element of funding that perhaps you aren't aware of, all to do with loan books and financing fintechs. So stay tuned. Obviously, when anyone's moving money overseas or loans, especially here on the African continent, there's a great deal of compliance and regulatory controls that need to happen and need to be adhered to. With the help of our dear sponsors, LexisNexis Risk Solutions, who have a suite of AML and KYC and KYB solutions in order to help companies remain compliant, without technologies and services and products like what they offer, it leads to all sorts of issues and challenges. So if you are in the market for risk solutions to mitigate those risks, I should say, then please do reach out to our friends at LexisNexis Risk Solutions. All their contact details on the bottom of the description. Thanks a lot and enjoy this episode.
Hey everyone, welcome back to another episode of Talking Success. We're going on, again, a different tangent today. We've spoken a lot about funding, we've spoken a lot about venture capitalists and private equity, and we've spoken about startup funding. And there's an element that I don't think we have covered. And when Nelson and his team reached out to me and said, look, we offer this, do you think it would be of interest? And I said, absolutely. Nelson and I had a quick chat sort of a week or so ago, and I said to him, listen, we're going to have to stop speaking, otherwise I'm using all my questions now, and I'm going to have nothing left for the podcast. So I'm delighted to be welcomed by Nelson Chu. Nelson, thank you for joining, all the way from the US of A. Good to have you on. Thank you for coming on and sort of sharing some insights, I think, really, in terms of the world in which you operate. Before I kind of delve into questions, it'd be great to get quick overview, who you are, what you're doing at the moment, what your background was, and I think importantly, what attracts you to emerging markets? Because obviously a lot of our audience, or most of our audience, is focused on emerging markets, specifically in Africa. So where is the common ground?
Yeah, thanks so much for having me. And looking forward to this conversation. We are touching upon probably the other side of the asset classes that you didn't really hit on here, which is private credit. We'll go into that a little bit. But my background first, specifically, I did start my career in traditional finance. I think building any sort of capital markets fixed income type company probably requires a little bit of traditional finance experience, but it was only 2.5 years. So not too long. Left that to really do my own thing. And so I was like stumbling around trying to understand what I wanted to be when I grew up at the ripe old age of 22. And then I realized that, you know what? I'm going to start a company. Let's see how it goes. So I ended up literally, I think, starting a company, failing a company within 6 months, just trying to start another company because I had no money. And then I think when you're broke, you end up being some sort of freelancer or consultant just to kind of pay the bills. And that turned out to be my first real company, at the very least. And so that was a consulting company that helped other founders build their companies from the ground up, not making the same mistakes I made in those 6-month time period. And so we did a lot of product, marketing, branding, engineering work. It all worked out pretty well. Had a couple unicorn clients that came out of that when we met them, a single founder. And so that was what got me really going, saying, you know what, we have a team that knows how to build stuff. We have hopefully good ideas. And we also have good access to VCs and investors since we got to know them over the years. So why don't we build something the old-fashioned venture-backed way? And that's kind of how Percent came to be. It was a right place, right time situation where we thought we could build an interesting company at the outset and just be flexible and adaptable to see sort of how the market changes based on what we do, and then continue to pivot from there, which is a classic founder journey. So when we first got started, our goal was to build a better alternative investment platform, something that had a better value prop than other platforms that were out there at the time. So that would mean shorter duration investments, like 1 month, 2 month products, which is great for the average retail investor. Lower minimum products. So instead of 25 grand, let's do $500. So you can almost like try before you buy the product and just invest for $500. No harm, no foul. If it works out, you'll be more interested. And make sure that our yields on these products were comparable to everything else that was on the market. So that was like 9 to 16% pre-Fed interest increasing rates in the US. So that actually worked out quite well, right? Like we had a lot of interest, we had a lot of people going for it. But ultimately, we realized there was no tech in the space whatsoever. And so in the asset class that is private credit, which I'm sure we're going to go into in a little bit as to what that is and how that affects everyone around us, it was one that we saw a huge opportunity to really build the infrastructure for the space, recognizing that if we were having these problems, literally everybody else probably having these problems as well. And from a technology standpoint, whether it's order book management, compliance management, portfolio monitoring, all those things are things that we knew we had an opportunity here to build on top of that. And that's sort of how we got to where we are today, which is pretty tried and true capital markets infrastructure, specifically for private credit markets.
Fantastic. Right, let's unpack private credit. Okay, it may be a term that people aren't familiar with. I know when we first sort of spoke, I was like, I get the concept. I think I've heard it maybe called something else before. But let's unravel it. What is private credit? Where does it fit within the ecosystem? Who is it designed for? And how does it differ to other credit models there are out there?
No, great question. And it's one I get asked all the time because they feel like they keep hearing about it. They've probably actually interacted with it and they didn't realize it. So private credit, let's just talk about private markets as a whole, because everyone knows public markets, yep. Stocks, bonds, things like that. On the private markets, you have a few core asset classes, right? You have private equity, and then the subset of that is like venture equity. You have real estate, you have infrastructure, and you have private credit. Right. So private credit specifically, the easiest way to think about it is just non-bank lending. Right. So going back to the global financial crisis in the late 2000s, you had a world where the banks were doing a lot of lending to consumers, to small businesses. And the way bank lending works is literally I have deposits that I have to pay very little interest for. And then I have loans that I extend that I get paid very high interest for. And then I make the margin, which is a great business to be in because your deposits is basically free, right, in terms of what you pay them. So wonderful. After the global financial crisis, all the regulators said, you know what? I'm going to make it very expensive for you to do consumer and small business lending because you kind of screwed up. And so the fact is, these consumers and small businesses, the need didn't change, right? They still needed loans, but banks weren't able or willing to extend them anymore. And so you had all these non-bank lenders come into fruition because to fill that gap, right? Now, private credit has been around for decades, but it didn't really take off until post-regulatory enforcement and post-global financial crisis. And that's when it really kind of skyrocketed. In that time frame, you had a lot of non-bank lenders appear, and they oftentimes were backed by VCs because they were like, this is a huge opportunity, great market, already established, people need it, but banks don't want to be here, right? And you saw this influx of companies that go into that space. Now, the tricky part with a non-bank lender is that they, unfortunately, again, are not a bank, so they don't have deposits, so they don't have any base to fall on or fall back on to be able to extend these loans. So they have to raise money from somewhere else, and they tap the private credit markets for that. So in terms of examples of private credit lenders that maybe people would recognize, you have these, buy now, pay later, even like student loan companies. Anyone that's private in that sector was effectively or is effectively in private credit. So in the US, you have like Affirm. Overseas, you have like Klarna. Those are all kind of non-bank lenders, private credit borrowers, things like that, that people probably interacted with when they checked out at an e-commerce site and didn't realize they were interacting with private credit. So as an investor in private credit, you have the opportunity to get exposure to their loan portfolio, right? So these are going to be millions of consumer loans, millions of small business loans that are all kind of pooled together so that in the event that one consumer says, you know what, I don't want to pay anymore, well, you have, call it 999,000 other loans that will help fill that gap just in case. So that's kind of the best way to think about what private credit is.
Okay, very interesting. And then we'll get into kind of where that fits within the ecosystem at the moment, but in a minute. But from an investor's perspective, so as a private individual, I can go and invest, can I, within different portfolios? How do I go about doing that? Is that through your platform? Is that through some other mechanism? Is it regulated? Is there controls around this? How does that work?
Obviously, the only way is through percent. I'm just kidding. There's obviously a lot of different private credit funds that have emerged to take advantage of this, right? The ones that you probably recognize because they're very well known: Apollo, Blackstone, Ares, KKR. Those tend to be pretty high minimum, and you have to get it through like an investment advisor, for example, or something like that. But those are available, right? And those are going to be arguably probably the safest because they are so large. They go after the largest companies. The yields are lower, but you do end up getting safety diversification in that way. Now, that's what we call like the large caps. There's middle market funds that are smaller than those guys, where you can potentially invest as I would say, generally like a qualified purchaser. So in the US, that means like 5 million net worth and up. But again, that's not terribly approachable because the minimums are still about 250K, right? So you have to really want private credit, or you're just have enough money that doesn't really mean that much to you. And then you get into the lower middle market segment, which is sort of where we play in, right? And the lower middle market segment is where you get a lot of optionality. We do have those $500 minimums. We do have shorter duration investments, things like that, which is very attractive for what is normally a regular retail investor who may have like an equity portfolio and whatnot, right? In the US, you do have to be accredited to invest in private credit. So accredited means a certain income threshold or a certain net worth threshold. In this instance, it's like $1 million. But that is the one gating factor. That's a regulatory rule, not a percent rule. On the actual options to invest in a fund, you don't really have much say, right? You kind of just give it to them and they do what they please and they'll report back on statements as to how they did. In the lower middle market space, and with us in particular, it gets a little bit interesting because you do have the ability to invest directly into specific opportunities that we've structured. So there's a lot of emerging market opportunities. We've had deals in Latin America. We've had deals in Africa. And you have investors who specifically like to invest in emerging markets, either because they see the opportunity, they see the alpha, or it's because it hits close to home for them because they may be, from that country or something like that and want to support companies in that region. The other option that we provide is also what's called like a blended product. Almost think of it like an ETF for private credit, where you invest in a theme. It could be ABS only, asset-backed only. It could be US only. It could be emerging market only. It could be total market, whatever it is. And every deal that meets that criteria gets a little bit of sliver of allocation. So you can almost like invest once and set it and forget it effectively. And that's a great opportunity to get diversification, similar to a fund, but with higher yields because it's a different segment of the market.
Fantastic. It's super interesting. You obviously just mentioned emerging markets. You mentioned LATAM and you mentioned Africa. Let's talk about that, if I may, because I think when we first spoke, I said, listen, love to have you on, but we kind of need to be, relate to our audience, which is, again, sort of 95, 99% across the African continent. Where does the business fit in that realm? What sort of, whether it be case studies, if you can share them, I don't know if you can or can't, or examples of some of the projects that you've been involved in that have taken a company from X to Y. Can you elaborate?
For sure, yeah. So we talked all about these, private credit borrowers. These are going to be your non-bank lenders, and they could also be corporate, like single corporate loans, right? You have like venture-backed companies who are looking to not take as much dilution, extend their runway, get to their next milestone, whatever it may be. Those are all options of private credit, right? You have a pool of loans that you're investing into, and that's called asset-backed, or it's a single company, which is just corporate debt. So the private credit industry naturally generally took off in the developed economies, right? Because there's a lot more capital markets infrastructure, it's more easily understood, and there's a lot less risk perceived, at least, because in the event something goes south in Latin America or in Africa, it's easier to kind of chase the money because you live in the same country or live in the same state, even the same city as this person. So it does make it a little bit easier. Yeah. But what's been interesting is the ability for emerging market economies to grow very, very quickly and almost bypass a lot of the problems that were being had in developed economies because, for example, the US still requires you to write physical checks for rent, for example, or something like that, which is just absolutely ridiculous. That means that being able to chase a paper trail is a little bit more difficult, right? It's a physical paper trail. In the emerging markets...
Nelson, I just need to stop you there.
Yeah.
Just for everyone that's listening, a check is this bit of paper that you have to write on, okay? And you give your physical signature, and then you give that to someone, and then about 3 weeks later, the money comes off your account, and about 4 weeks after that goes into their account. I just need to give that some context, Nelson, if you don't mind.
That's fair, yes.
In this part of the world.
That was FinTech back in 1950 or 1960, by the way. So yeah, it's come a long way since then, but there is still that happens in the US, right? But then in emerging markets, they bypass that altogether because of mobile. So you can actually do credit checks based upon how often they paid their mobile bill, because you don't have a FICO, which is in the US sort of how they do it here. And you have a situation where everything is transacted through the phone, which means that there's a digital trail that you can actually chase and confirm and make sure things are happening. So in doing so, it gets to be really interesting in emerging markets because you have a level of technology that is arguably on par, if not better, because it is also so digital or so mobile first. And that's tremendous, right? So there's a ton of opportunity in emerging markets to be able to provide private credit, but at the same time, the private credit market is so small in these regions. So it is like taking off, right? Like Latin America, for example, I believe makes up like 5 to 6% of all of private credit, which is insane considering how, I would say, even mature it is at this point with the amount of fintechs, the amount of VC money that's flowing into it. Africa, clearly way less than that, right? And yet there's a huge, huge opportunity there. So you are seeing a lot of funds shift their interest or even be emerging market specific because they see the opportunity there and they see the arbitrage that they can actually capture. So we like it a lot. We've done deals in Latin America, so Mexico, Colombia, Peru, etc. We've done deals in Africa, including Tanzania, and so we've seen that. Now, the only caveat I would say is that we do expect a certain level of structure from a deal, like offering standpoint, that is almost like understood in the US and in developed economies that doesn't quite exist in some of these other countries. And we have to kind of work our way around what currently exists there to be able to adapt to it. So for example, in the US with each bank, you can set up a cash control account, which makes sense because if I'm giving you money, I kind of need to have access to this, right? It doesn't quite exist in Latin America, but they have something called a trust account, which is even more secure than a cash control account, which is like, great, we'll take that. And so in Africa, we had to really kind of figure out exactly what type of structure would work when we did the deal in Tanzania, which was really interesting. But again, huge opportunity, ripe for growth, arguably going to grow faster than developed economies. And that's a great opportunity for anyone who wants to tap into it.
So let's paint a picture here, if I may, in terms of sort of a couple of user cases. So I'm a fintech. Maybe I'm into one element of fintech. Maybe I'm into payments, and I want to add a service layer on top of my payments offering, and I want to add BNPL. That's a really good example. Okay, I don't have necessarily either the ability to go to a VC. Perhaps I don't want to go to a VC. Perhaps I don't want to go to the bank. But I still want to offer this service. I don't have the capital. I don't have the balance sheet in order to support that deal value or the type of loans. I would then come to you and say, right, I need funding for this new product. You're not going to fund the development of this. You're going to fund the loan book. Am I correct in saying that?
Correct, yes. Although that is a little bit tricky because the first thing I will say is lending is very hard as a business, just in general. It's very easy to give money. The hard part is getting it back, essentially. That's the problem with lending. So in this instance, for a company, just using your example, because it's a good example, a company who doesn't do loans and doesn't do buy now, pay later will have no shortage of embedded lending, banking as a service, lending as a service type companies they can partner with to offer the product, right? And we have no shortage of ways to provide them the financing they need to grow that loan portfolio. But are they actually a good lender is a very, very big question. It's one that, I think as a embedded lending or embedded banking provider, you have no skin in the game, right? Like it doesn't matter to you whether this succeeds or fails. You might lose a client, but at the end of the day, there's no balance sheet risk that you hold. We take that or we hold that, which is very, very tricky, right? So we have to do a lot of work to ensure that you as a company actually understand how to do lending. And the even trickier part, I guess, is that because you talked about raising venture capital or choosing not to raise venture capital. Generally, every single lender started by raising venture capital because they couldn't raise money for anywhere else. They use equity, which is the most expensive form of capital, to finance their loan portfolio, build up a track record, and then raise debt. Yeah. The tough part of being a venture-backed lender is that venture growth, venture scale requires you to go ham on the loan portfolio, right? You need to kind of go like that. You can't just, I'm profitable now. I'm even more profitable, slightly more profitable. They don't like it that way, right? They want 10x, 100x returns, or at least the possibility of that. And with lending, every time you do that, the only answer is to widen your credit box generally and to spend more on marketing to be able to acquire that. So lending is hard as is. Lending as a venture-backed company is even harder because you need to be flawless in your underwriting capabilities.
Okay. So, all right. So taking that into account, I'm a business, maybe I'm an established business with the current loan book, but I want to expand. I come to you. What do you need from me as a fintech in order to satisfy your requirements? Because obviously you're not going to lend money to ABC FinTech that says I've got 50,000 loan disbursements and this is my collection rate or my default rate. What is it that you need? And is this actually, answer that question first because you might answer my second.
Sure. Yeah, no, what's interesting about fixed income versus equity, although nowadays with the way venture capital is going, it's almost like structured equity, which is a whole separate ballgame. But at least on the fixed income side, you can structure away risk, right? And that's kind of the beauty of it. So even on our platform, we have like 52 different attributes and levers that we can pull around a deal to be able to structure away that risk. So just because it may be a C or a B level portfolio doesn't mean you can't make it a B or A level offering, right? Because of the inherent structures you put into it. So for example, let's say your total loan portfolio is $1 million, right? And your default rate is, let's say 5% over the course of the last 12 months. Yep. Well, I could just choose to actually give you 80 cents on your dollar, essentially, right? I'll give you 800,000, and historically, you've never defaulted more than 50 grand, so I shouldn't have any issues. I can also make you post up that additional $150,000 delta there, just in case, as like a fallback, right? That's like a reserve. I can also increase your rate to basically accommodate for that risk that I think I'm taking. There are so many different levers that we have to pull to be able to structure a transaction in a way that ultimately protects the investor. And so we've seen this time and time again. A loan portfolio may be very new. It may be gone through its own trials and tribulations over the years, but then now it's like right sized. But I could use the old version of the performance as like the floor that we're structuring against. Things like that, right? So we never turn down somebody because its performance seems like iffy, right? We have to really dig into the details and see what's really behind the numbers, and then see if there's a way to structure around it. And that's kind of the beauty of credit versus equity. It's like, yeah, I mean, I hope you do well. I'm going to try and help you if you do well, but that's about all I got. And so, you can slap in all the liquidation preferences you want. It's not going to change the fact that the company doesn't do well. Your liquidation preference of 2x is still worth 0 at the end of the day. So, good luck. Debt is very different in that instance.
So there must be a hell of a lot of sort of due diligence that you go through, your business goes through when you're onboarding, a new partner. How long does that take? Are we talking sort of months and months, or?
No, I mean this is going to be horrifying if our investors are listening, but they should know this already. So we raised about $48.5 million in equity over the course of the last 4.5-5 years, right? Which is wonderful, but about 6 million of that went to legal, actually. And that is sort of tried and true in securitization, in fixed income, just in general, capital markets, right? And the reason for that is because we wanted to create a structure that was very turnkey. A traditional ABS deal, asset-backed deal, like financing a loan portfolio, which is what we've been talking about as an example, normally takes like 6 months in sort of the regular world, right? We've gotten to the point where as a structure, we can stand it up in about 2 to 3 weeks. So it's actually just on diligence at that point. Like, how long does that take? Because the structure itself is repeatable. And the beauty of a standardized structure is actually that it also makes comparisons possible. So all those 52 attributes that I listed out, or I talked about earlier, you can actually use those and compare them against another deal that's in our platform, right? So you can understand why it's priced a certain way because, this one has a higher default rate, but they gave them less money. They gave them 60 cents on the dollar, right? And they also made them post up like 2x the collateral to backstop it in case something goes south. So yeah, this is technically a riskier portfolio, but a tighter structure, so it's priced less from a risk standpoint. All these things you can compare just in a table, side by side. And that is where $6 million worth of legal bills went, to create standardized templates, standardized structures, comparable structures, and it's worked out very well for the investors who are happy with the outcome of the efforts that we put into it.
I'm not even going to talk about what lawyers charge. That's a whole other conversation. But okay, that makes sense.
Next podcast, but yeah.
Yeah, absolutely, yeah. So I guess from a process, if I am a fintech or I'm an MFS or whatever I am, and I'm interested in extending my portfolio, funding it through private credit. Is it fairly self-service? I mean, I come on to the platform. Do I sort of upload documents? Do I upload my balance sheet and my loan book and what have you? Is there some sort of AI that's, because everyone uses AI, right? I mean, can't be a podcast if we don't talk about AI in 2024. Is there some sort of tech that sits behind that does some decisioning, or because of the value of and not necessarily the value, but because of the criticalness of what you're offering as a service, so lending as a service? I don't know if that's such a thing, but maybe it is now. If you're offering that to a customer, is there more sort of hand holding? Is there more sort of engagements? Is there more sort of interaction as opposed to I want to go and get a bit of credit online, a payday loan? I go on, I put in my details, and 3 hours later,
You don't talk to anybody.
So
Yeah.
yeah.
No,
How does it work?
Great question.
Is it high touch?
Sure. So, yeah, everything we've talked about thus far has almost entirely been our marketplace, right? We have borrowers who are, let's say, fintech lenders who need money. We have investors who are accredited or high net worth or whatever who want to earn a return, and somebody is in the middle structuring, whether it's us or somebody else, right? That is our marketplace through and through. The other side of the house is our tech business, and that is nascent, but it is sort of a learn by doing exercise. So over the past 5 years, we've done about 575 transactions, roughly, give or take, and with the explicit intent of learning what it takes to do deals in this space. Like we said, right? Like we started off as marketplace, pivoted or evolved into infrastructure. 575 deals will teach you exactly how to do deals in this space, to be honest. And so every single time we shipped a new feature, it was to make us more efficient, right? Yeah. And so we launched, for example, order book management, compliance attestation, portfolio monitoring, things like that, to try and make it as low effort as possible for everybody involved in the process. To the point where even with legal tech, we can offer a product in like 2 to 3 weeks if everything goes according to plan, right? Which is great. So from a workflow standpoint, we have a platform for the borrower to manage their entire debt capital markets lifecycle, which means you touched upon it, uploading files for due diligence. We have data room functionality, being able to collaborate and communicate back and forth with the underwriter, in this instance, us or somebody else, to who's structuring the product, and then ultimately launching a deal, seeing how it goes, closing the deal, and then post-close, they have to provide ongoing reporting, ongoing cash flows, obviously, because investors need to get paid. We provide all of that in the borrower portal, right? On the underwriter side, it is full end-to-end workflow. So sourcing, you can find a borrower on our platform. You can structure the product, which makes sense. You got to be able to set up a digital PPM, like a digital private placement memorandum, so investors can diligence, set up a deal data room, do a roadshow, like whatever it may be. We give you all the tools for that. And then post-close, we handle a lot of the work around cash flow servicing and reporting, since the borrowers gave us that information, right? But again, they can rely upon us for that. And then for investors, same way you'd invest with equities, I'm going to go look for a deal. I'm going to invest in that deal, due diligence on it, and then make sure my money comes in after. So all that workflow is things that we've built over the last few years that is now really coming into its own, which has made our own efficiency extremely high. And so we're running from a gross margin standpoint, like some SaaS company level margins, essentially, which is incredible to hear for a marketplace, which is normally very heavy lift, which is, again, proof that I think the tech is working and it's making us better. So hopefully everybody else can be better as a result as well.
Fantastic. Last point, and I'm not going to finish on kind of a low or a negative, but I think it's prudent. Okay, and you mentioned it a couple of times, the sort of the risk factor, and again, I think there is always an element in investing, especially in emerging markets. There is volatility. We have civil unrest, we have political unrest, we have lots of different things that contribute to quite a rocky market, okay, or markets. But by having a kind of a control account or maybe an escrow account or something of that ilk, how are you protecting your investors and how are you ensuring that when you're dispersing these kind of relatively big ticket loans or financing, that you are able to recover that? Because there's also been a lot of stories, and we don't need to start talking about FTX. I'm not suggesting that this is anything like that, by the way. But that there is a bit of nervousness around the market, from investors' perspective, but also I think from a fintech's perspective, saying, okay, I can go and get a loan book of $1 million. How do I know that those funds are going to be there tomorrow, right? So, what is the protection on both sides?
Yeah, and I think there's rightfully so some semblance of a concern or question around risk, right? And equities is viewed differently than debt, because debt, it's kind of like, I expect it to be there if the company does what they say they're going to do. Equities is kind of like, I hope it works out. I have already written this down to zero, just in case, right? Like, you kind of go in with your eyes wide open. If you don't, as an angel investor, then I think you need to, start to get there generally. But for the debt side, yeah, you hope it performs. So in that instance, there is a lot of things that we've done working with the regulators and working with the legal structure and framework within each country to be able to actually ensure that we have recourse, right? Short of us physically flying there and chasing the money down, which we tried not to do. So each country is different. Yeah, exactly. Each country is different. And we've seen that the US structure tends to be the one that we want to mirror, because we know that there is recourse in that instance, right? So the bar, naturally, this is not like we almost have no choice but to do it this way, but the bar for companies in Latin America and in Africa are going to be higher naturally, because we want to set almost like gut check, did they have good VCs who basically did good diligence and went to the country or are in the country and they have credibility there, versus just any random company is going to be difficult for us, just because we need to have some sort of external validation to be able to make it a better situation. When it comes to geopolitical, that is hard. Things happen overnight. We've experienced that once with a company in Latin America, and it was just like, oh geez, the regulators just came down hard on this business, and they didn't like it. And we thought, based on our diligence and everything we heard about, even doing a reference check with the VCs, it was like, yeah, the government loves these guys because they're offering this to open up an underbanked population. Like one day later or a couple months later, they just said, I don't like it anymore. You're the worst company ever. And it's just like, well, that wasn't in my due diligence packet, if that's the case. So it's hard, right? But I think the beauty of it then, going after venture-backed companies in emerging markets versus non-venture-backed, is that if you're venture-backed, you do have runway to figure it out. Versus if you're not venture-backed and you're just riding off of profits, it's difficult, right? Sometimes to be able to kind of come back from that. So we try and just maintain a higher bar from a cash balance standpoint for some of these companies in emerging markets, just to be able to better protect it. Because the structure-wise mirrors what we have in the US, and technically from a legal standpoint, there is recourse, but it's the unknowns that you don't know, that you don't know rather, that are what usually sometimes gets you. And that's the one that we have to hedge against through having a bigger balance sheet with these companies that we can kind of go after if we need to.
Well, look, it's a fascinating model, one that I'm very pleased you shared. I've learned a lot. Now, for people that are interested in knowing more about this, knowing more about private credit, knowing more about how they can get involved, perhaps not from an investment perspective, but certainly as a potential partner of yours, where can they go? Where can they look you up? What's the website URL? We will put everything down here, but it's nice to say it anyway.
Sure. And actually, it is both sides of the market. So if you are a fintech lender who wants to borrow or get financing for your loan portfolio, happy to chat with you, right? We also do take international investors as well. And so that is very easy to get access to these opportunities. The only thing we don't do is take care of your taxes. We are full service, but not on the tax side. But other than that, you can invest in these opportunities, right? So you can just find us pretty easily. It's just percent.com. And then I'm always happy to chat as well. It's just nelson.chu, CHU, @percent.com. If there's any questions around the borrowing side or the investing side, or obviously our team is always happy to chat as well.
Wow, that's amazing. Listen, thank you so much. I've thoroughly enjoyed this. Learned a lot. You know what? Someone said to me, you do these podcasts and you can learn stuff. I'm like, absolutely.
I'll make the best part of it.
But that's one of the benefits of being a podcast host, I suppose, in a subject and an area that you have a bit of a thing for. So I've learned a great deal. I'm going to let you get back to your day. Actually, your day's probably just starting, and mine's just ending. But it was great to meet you. Thank you to you and your team for setting this up, and all the best with the business and the expansion plans. And I hope to see you over in this part of the world very soon.
That's the goal. Would love to. Thanks so much for having me. It was great speaking with you.
My pleasure. All the best.